Good morning, ladies and gentlemen. I have to apologize. We still haven't been able to access the right database and fix these daily scores. As you can see, they're just being copied from one day to the next. But I assure you there haven't been any significant deviations from this score, and we will let you know whenever there is one. Unfortunately, it might be another week before we are able to fix it, but in the meantime, as I said, I will definitely let you know if there are any significant deviations from the score that we have at the moment. In the meantime, let's examine what the market is saying and what it's been doing this week. And as always, we start with the yield curve where there are some significant developments. The 2s10s undoubtedly are at a very crucial junction, just like all the other yield curve spreads, which I will show you. And basically, my contention, my favorite direction of travel is down. We are exactly where we were at the beginning of the year before the big steepening, and we've been flattening ever since. We've been flattening basically ever since March, and I think we can continue to flatten. And if we start now breaking this 98 area, you can see that, first port of call is going to be 79, and after that really we have to go back to 53, 54. That is my favorite direction of travel, but all I'm going to say is that we are at a very, very pivotal level. We will not hang around here for very much longer. We go either one way or the other. And therefore expect big developments in the next couple of weeks in every single tenure of the yield curve. Everything else is exactly at crucial levels, just like the 2s10s. If we have a weekly chart of the 5s 30s, well, here we are at this 105, 109 area. Absolutely crucial, because if we start busting through here, we're going all the way to 81 basis points, and this longer term moving average, that's on the weeklies. If we go to the dailies, you can see that we are busting higher. First stop 81. So the real question is it going to be a bear flattening or a bull flattening? I.e., will everything come down in yield, or will the 2s and 5s start going up and 30s and 10s not do very much? I think it's important to look at 10s 30s. 10s 30s have been screaming ever since this period, the beginning of the last part of last year and the beginning part of this year, that the market is beginning to discount the fact that the Fed might be right and the inflation is transitory, and that 30s are vastly outperforming the 10s. So if whichever part of the yield curve you look at, and this is 5s 10s, which really shouldn't be all that sensitive, it's showing the area around the 2s and the 5s staying bid, and basically the Fed normalizing the yield curve. We could easily get to a situation very soon, in the next couple of weeks are going to be crucial, where the yield curve goes more or less flattish. And the only way that I can see it at the moment happening, and I repeat, it's either going to be a bear flattening or a bull flattening, but a bear flattening is favored by me, i.e. the 2s and 5s start going up slightly in yield, and the 10s and 30s basically normalize and stay roughly where they are. This is a chart of the 2s. I think it's very, very likely that we start breaking up above these levels, And really, if we start breaking this 27 area, we could easily go and touch 45, 50. And that is my favored direction of travel for the very short end. What does that imply? That would imply that the Fed does taper. It would imply that the Fed does set a timetable for higher rates, towards the end of 2022, beginning of 2023, and that the market starts discounting that by A, flattening the yield curve, and B, taking the twos and fives possibly quite a little bit higher. If we look at the fives, they're nowhere near as bearish as the twos in terms of higher yields, but if we just enlarge this area, we can quite easily see this market turning up and going towards the 1% area quite easily without any problems. Could it be could we go down? Yes, but if we go down, there isn't really very much room for it to go down. It could just hug the 200-day moving average around 70 basis points. But I think the path of least resistance for the fives is upwards. While if we change it to the tens, I think stability is more likely than anything at all. I think, trading between 139 and possibly 151 is about as bad as it gets. And the 30-year, is as stable as anything. It just does not want to know about going up in yield. It keeps on failing whenever it goes up. And that, to me, indicates that the 30s are going to be the most well bid area. So whether it's a bull flattening or a bear flattening, I think the yield curve is in a flattening mode. Bear flattening whereby the yield curve pivots around the twos and fives, which go up in yield while everything else stays subdued or even goes down in yield. To me, that is at the moment the most certain trade, and that, of course, has implications for which area of the stocks performs best. We'll discuss that later. But if we look at the differentials as well against Europe, that is going to give us some signals for the dollar and for gold. Now, as we all know, and I've said for many weeks now, Europe is way, way behind the US in the normalization of the yield curve. This is the bubble, and it's basically stuck, around this minus 75 to minus 71 area. But to me, the path of least resistance here is going to be higher. Bubbles are by far my least favored part of the yield curve. The tens in Germany, I think, are likely to remain far more stable than the bubble, whichever way the market goes. So if the market goes down in yield, the most bang for your buck is going to be in the Bund rather than the bubble. I think there's going to be more stability here in the Bund than there is in the bubble. To me, the bubble is the danger area. And if we look at the differential between Bunds and 10-year notes, we can see that we are going into Jackson Hole exactly at 175 basis points, as I predicted. From here, we will have quite a nasty move one way or another. And whichever way this goes, that will have implications for the dollar. Gun to my head, I think we will retry this 180 area a couple of times. That's gun to my head. I mean, I have absolutely no favored way at the moment. And that would indicate to me that the dollar is going to be remain under higher pressure for the time being. But if we look at even the Italian BTP, you can see how how we are at a very, very crucial stage. And also, if we look at the OATs, we will see that we are, again, we could easily come down to this minus 22, 23 area. But I think the 10-year note is the 10-year rather in all of these markets is not going to be hugely under pressure, but the pressure is going to come at the shorter end. The Dixie, well, it closed above 93.14. The direction, if I'm right, and the 10-year remains roughly static, but it outperforms the bonds on the upside in yield, and if the twos and fives in the US start normalizing and going higher, that is going to put upward pressure up towards this 94.80 area in the Dixie. On a daily chart, we have room to 95.07. That's the kind of area that I would be guessing we would be pushing if I'm right in my view in the bonds. If we have a look in Euro USD, that is basically 115.34, and on the weeklies, what is that? 115.50-ish. So that is the area that we are looking for in Euro USD terms. The 200-day moving average is now turning over. It looks like it's a time for pressure, upward pressure on the euro, on the dollar, and downward pressure on Euro USD. And the only thing I think that is going to make that happen is a bear flattening, because I really can't see the euro rates leading in any which direction. So it has to come from the States. And the only way that I can see it coming from the States is through higher yields in twos and fives, stable yields in tens, and maybe even lower yields in 30s. And that is going to give some upward pressure to the dollar in general, because those rates are the differentials are going to go out, as I showed you in the 10-year area, out towards the 180 basis points again. A bear flattening would not be good for gold, because at best you can expect the long end of the curve to remain stable, but that pushes up the dollar. So the third derivative, i.e. gold, should be under some pressure. Not huge, because one leg is not really doing very much, but the other one is bearish. So really, it's not good for gold. It's not enormously bad for gold, but there is no impetus to the upside. What would that translate to? That would translate to in slight pressure back down towards 1,710. We keep on failing. Every bounce is slightly less high, lower high. If I enlarge this area, we can basically see how very, very important this 1830 to 1840 area is. We really have to break that to have any kind of impulsion. But the 200-day moving average keeps on coming down. It's more likely than not that if the Fed does start normalizing the yield curve, that gold goes back down into the low 1700s and basically tries to trade these levels, 1685, just to see if it can break lower. I don't think it will, because the pressure is not there from the bonds, but I still think that the direction of least resistance for gold at some stage is down. And DBC is finally catching it in the neck. This is on a spread against SPY, and as you can see, it held in, and now it's breaking out. Probably going to go and test this 26th, 27 area. So that means that the pressure is going to remain on DBC. For the first time in several months, it has really broken down below this 1840 to 1868 area. I think it's basically now going to have a tough time going through it again, and at some stage it should test the 1671 area, where I think it's probably going to be a good buy. And that also is another indication to me that we're going to get some flattening, some bear flattening in the yield curve. This 1671 area is going to be very important. Look at it here and look at it here. So, how did I get back to 1690, 1671? Here we are. So basically, this is the area, and this is the area that it trades in when it can't or comes back from the 1868. So this is the kind of area that I would play for a bounce in DBC. Not before then, I don't think. Might take a couple of weeks to get there. But that to me is another indication that the yield curve is likely to bear flatten. And basically DBC is likely to remain under pressure for the next several weeks. If we actually go to Dr. Copper on a weekly, here we are. We're doing some kind of an ABC, which could easily see it trade around this 3,620 area, something like that. This kind of area. You can see how important it's been, how many highs and lows there are on the weeklies at that area. Comes down here over the course of the next several weeks, and then it can start going higher. Again, another sign of bear flattening of the yield curve. Well, what a weird and interesting week we had in equities. As soon as it broke the 44.26 area, down we went to the next support and through it, and it was looking like it had this 43.17 area written all over it. Nope. The Bollinger Bands were just too strong, straight through this 44.26 again on Friday, and as soon as we did that, all the selling pressure completely disappears and we're just going sideways. This is on the 195 minute. If we have a look at the daily, we had this daily Bollinger Band underneath it, the 50-day moving average, just too strong, straight back up, and now we probably, until we get to Jackson Hole, they're going to try and fill this gap up here and stop everybody out on the higher levels. It's more likely than not, isn't it? But, at Jackson Hole, if we get the kind of bear flattening that I expect after it, that is actually going to have more effect on sectors than it is on indices. So what it tells me to indices is these Bollinger Bands are absolutely right, that the indices themselves are going nowhere, but then you should have some profound moves in the sector spreads. Before I go and have a look at the spreads, I want you to understand why I think it's going to be against tech spreads as opposed to any other spread. Look, Nasdaq is basically a function of long-term rates. It's the highest, it has the highest duration, and therefore it is the most sensitive to duration. If it's a bear flattening whereby the bonds do very little or do slightly better and everything else does significantly worse, then Nasdaq is going to be the least affected. But if it's a bull flattening whereby the bonds, the longer term bonds do well, again it's going to be and outperform the shorter tenures. Again, it should be the one that does best. So really, it's all going to be against tech. So it's all going to be against XLK. And if I'm right, XLK will start outperforming. This behavior last week, whereby we couldn't even go to the next support, and we stayed very well bid. And if you have a look at the weeklies, what we did is close with a hammer within a whisper of where we were the week before. All we're doing is going sideways, yeah, and basically closing the week exactly where we opened it within, no difference at all of where we closed the week. Basically, we are exactly where we were a month ago. We haven't moved an iota. So that tells me that it's all going to be against Nasdaq. And therefore we look at the technology spreads. Now, if we get a flattening of the yield curve, that is, whichever way it happens, that is not so good for the XLF, because financials like a steep yield curve. They like to borrow short, lend long, and therefore the bigger the differential, the better it is for XLF. When the yield curve flattens, they have less of a spread, and therefore they make less money. It's really good for XLF if long-term rates remain stable, or they start doing XLK if long-term rates are stable or lower, and therefore you would expect really the move to be in XLF, XLK to the downside. This kind of level now becomes crucial, and I will put a reminder, an alarm right here, because if we start breaking now this 2347 area, we're going to have another leg lower. We're going to have another something of this magnitude, and we are going to retest the lows. We are now at, what are we now? 2420, and lows down to 20. That is nearly that's nearly a 20% relative move between XLF and XLK to the downside. If we look at XLI, it's showing a very similar pattern, whereby XLK has stopped underperforming XLI, and it could easily take out these lows. So basically you're talking about Nasdaq vastly outperforming something like DJI, and this is the NDX over the DJI. We've been faffing around doing absolutely nothing since this is July of last year. Okay, so the NDX has not outperformed the DJI for a year. Is it time? I think it might be. I think the path of least resistance now is that we start breaking these highs and we, boom, go higher. QQQ against SPY. This is all the way back to August of last year, QQQ to SPY, nowhere. Exactly the same. So for a year we've gone sideways. I think it might be time that we start breaking higher. So everything is indicating to me that if we do get a a bear flattening of the yield curve, or a flattening in general of the yield curve, the outperformance is going to come from the tech sector. It's going to be far more bid than everything else, and these spreads are the ones that are going to have the biggest relative move rather than the indices themselves. Now, this theory of mine about the bear flattening of the yield curve actually would explain the pieces that I've been puzzling over, which is EEM and Nikkei. Why is EEM under pressure? Why is Nikkei underperforming so much? Well, because you've got if the bear flattening happens, that actually puts pressure on the dollar, that puts pressure on EEM, and here we are. This is exactly what we are seeing. If we enlarge this area of the weeklies in EM, the ABC basically targeted at least here, and we got there. You can see how we are, below the Bollinger Band, the weekly Bollinger Band, but that shows, with bounces, sustained pressure down towards this 48 area, and probably just a little bit lower to the round 46 area. Continued pressure in EEM, continued pressure in Nikkei. You can see that we bounced off the 26,910 area, but the pressure is still there. Every single it's very much like EM, isn't it? On this weekly chart, you have these Bollinger Bands coming out, and it's slowly dribbling lower. Don't forget that it's going to have the support of the BOJ all the way, but it's still looking as weak as a kitten relative to what SPY is doing and what I expect NDX to do, i.e. the outperformance of the tech. And these are the indices that have the least tech component, high tech component, and therefore these are the ones that you would expect to do relatively worst, and that is exactly what's happening, and that might be the piece of the puzzle. I keep on talking about the tale of two cities. You have the US and Europe to some extent performing far better than these other peripheral these other markets like EM and the Nikkei. Why is that? Well, if you get this bear flattening in the States, that would really explain it. It would explain it insofar as it's the tech sector that remains stable to does better, and everything else does worse. So on to the biases. My biases are concentrated here in the 2s10s and the 5s30s. It is pivotal and it's crucial. Either we will bust this 105, 109 area and go, and my favorite way is through high yields in 5s and stable to lower yields in 30s. That's my favorite, but I'm prepared to accept the verdict of the market. If this does happen, we do get a flattening, whether it's bear or bull, then the implications are for the NQ spreads against everything here. Those are the implications. The NQ should be the one least affected, or the one that has the most benefit, i.e. the least affected badly. So the NQ spreads, the XLK spreads, are the ones to look at some stage next week, together with the flattening of the yield curve, which way it happens. That should still remain, the pressure should still remain slightly upwards for DXY and slightly downwards for gold and DBC. That basically explains everything we've been seeing for the past couple of weeks. and it should really come to a crescendo, to to an explosion after the Fed meeting at Jackson Hole. Thank you very much indeed, and tweet you on Monday.